Today we are going to delve into the subject. What is dollar cost averaging? Buying stocks can be stressful. You might feel regret if you buy too soon and the price drops, or you might feel like you missed out on a deal if you wait and the price goes up. Dollar cost averaging is a strategy that can help to minimize these risks. It involves investing equal dollar amounts in a security at regular intervals rather than trying to time the market. This means that you will buy more shares when the price is low and fewer shares when the price is high. Over time, this can help you to average out your purchase price and reduce your risk. Like most investment strategies, dollar cost averaging is not a one-size-fits-all solution. It can be a powerful tool for reducing emotional barriers to investing, but it is important to understand how it works and when it is most effective. Dollar cost averaging is an investment strategy that involves breaking your investment into smaller pieces and investing those pieces at regular intervals. This helps you to average out your purchase price and reduce your risk. For example, let's say you want to invest $10,000 in ABC stock. You could buy all $10,000 worth of stock right now, but you're not sure if the price is going to go up or down in the future. Instead, you could dollar cost average your investment by buying $2,000 worth of stock every month for 5 months. This would give you the opportunity to buy more shares if the price of the stock goes down, and fewer shares if the price goes up. Dollar cost averaging works because it takes the emotion out of investing. When you commit to a set schedule, you don't have to worry about whether a stock is about to move higher or lower. You simply invest your money on a regular basis, regardless of the market conditions. This can help you to stay calm and focused on your long-term goals. Dollar cost averaging is an investment strategy that can be used with any type of investment, whether it's a stock, mutual fund, or exchange-traded fund ETF. However, it works best in bear markets and with securities that have dramatic price swings up and down. In a bear market, the stock market is declining. This can be a scary time for investors who may be tempted to sell their investments. However, dollar cost averaging can help to reduce anxiety and fear of missing out. By investing a fixed amount of money on a regular basis, you are essentially buying more shares when the price is low and fewer shares when the price is high. This can help you to average out your purchase price and reduce your risk. If you do dollar cost averaging, beware of hindsight bias. It is easy to second-guess your decisions if you spend too much time looking backward. For example, if a stock goes straight up from your starting point, it would have been better to buy as much as possible on day one. However, the whole point of dollar cost averaging is that we have no way of knowing how a stock is going to move. I hope this video helps you in understanding better what dollar cost averaging is. Please remember to click on like and subscribe. After you have subscribed, please leave a comment in the comments section below and I will try to reply to your comments. I'd see you in the next video. Bye.